Joining us now, Ken Shinoda, portfolio manager at DoubleLine, and Lindsay Rosner, head of multi-sector fixed income investing at Goldman Sachs Asset Management. Ken, you look at this week and heading out of the initial election, you did see that surge in the 10-year. You're seeing some of that concern really seep out of the market for now, especially with the president taking some of the worst of his tariff threats off the table. But I think for now is the operative part of that statement, isn't it? Do you worry that the policies moving forward could send yields much higher, Ken?
Well, there's definitely a risk with what the administration will do with tariffs, that it could ignite inflation again. But I think we're in wait-and-see mode. We have to see what they actually roll out. So far, some of the rhetoric around tariffs has been much milder than previously expected by the market. I think just this morning or last night, news came out that Trump said that he hopes that he doesn't have to put any tariffs on China. And so I think a lot of the sell-off was pricing in more aggressive moves by the administration, and we were pretty oversold in bonds. So I'm not surprised that the market's calmed down now, and I think we'll find a new trading range here.
Lindsay, what do you do with that kind of a trading range? Do you buy at these levels? There are a lot of investors that have still been afraid to take on duration.
Yeah, so we think duration looks better priced than it has recently. So we agree with Ken on that at that point. The big thing here is just understanding that we're likely to be in a range. I think you pointed out something important, which is there's not anything priced into the market in terms of what is going to happen at this FOMC meeting next week. We are probably in a range for a little bit of time here as we wait to see what the policies will be. But what that means is that risk-free rates are really high in the U.S., and that gives us a great opportunity to be invested in bonds in the U.S. And that's what we're saying. Our big theme is that bonds do pay.
When you think about next week's meeting, it's worth going right there, isn't it? Because investors do not expect, of course, another cut in this upcoming meeting, but the path forward, given the uncertainties. Ken, what are you looking for?
Well, I think the Fed is, as they say, data dependent, and it's kind of made the market schizophrenic. You'll see how the bond market moves very violently to all the incoming monthly data. And right now, the Fed's kind of in a bind because they don't really know what's the administration's going to roll out. So I think they're going to stay on hold this meeting. The market's basically pricing that in, and they're going to wait and watch what happens with inflation and jobs data, and wait and see what comes from Washington.
How many rate cuts do you think could the Fed accomplish this year, Lindsay?
Well, they could certainly accomplish as much as they need to if the inflation or the labor market changes. What we think is likely to happen is 2 cuts as well. We think that happens for the first time in June and then likely again in September. That makes sense based upon our view of where inflation is going. We've done a really good job in the economy and the markets and understanding that inflation is coming down. It's not going to happen in core goods. That work is done. It's not really going to happen in services. That box is checked as well as inflation in the right side. What is remaining is OER, or this housing component. And we really believe, if you look at the real-time data on Zillow or other real-time indicators, we're seeing that rents that are now in the market are much lower. And that's going to work its way into that OER number soon. And that should allow the Fed to feel comfortable that inflation is, in fact, coming to 2%, which is exactly what they told us they were concerned about in December.
While that's certainly a sigh of relief, you haven't had such sticky inflation when it comes to housing for a long time. Ken, I am struck by the consumer sentiment data we saw even just this morning, where you have consumers expecting prices to rise 3.2% over the next 5 to 10 years and 3.3% over the next year, which is the highest they've seen since May. Inflation expectations, what role is it playing in this market?
Well, that data is very bifurcated. If you look under the cover, and it's politically divided, which is fascinating. The Republican voters think inflation is going to come in more in line with expectations, down towards 2%, and Democratic voters think inflation is going to be 4 or 5%. So the average between the two ends up being that 3 handle, which is above what the Fed's target is. And I bet if the election went the other way, it would be flipped. The Republicans would think that inflation is going to be higher, and Democrats would think that inflation is going to be lower. So You can't read too much into that data. If you look at break-even rates, they've moved a little bit higher, but they still remain contained. So for now, the market isn't that concerned about runaway inflation.
It's totally worth getting more into the politics of it all versus the monetary of it all, because of course you did hear from the president in terms of his own relationship to Fed Chair Powell. Let's take a listen to what he had to say.
I think I know interest rates much better than they do. And I think I know it certainly much better than the one who's primarily in charge of making that decision. But no, I'm guided by them very much. But if I disagree, I will let it be known.
There was a lot of concern about Fed independence coming into this cycle. Lindsay, do you still worry that there could be a push-pull between the president and the Fed chair, or at the very least, between the type of policies put in the White House and the Fed easing cycle?
So we're not really going to pontificate on if there is going to be Fed independence or not. We believe that the Fed will remain independent. I think we heard very clearly from Powell in December that the independence is in place. But in terms of policy's effect, that is really important. That's exactly what we're trying to figure out right now. And that is what is being priced into the market. I think what's interesting is back to January has zero probability in terms of a Fed cut. But if you look out in the probabilities for the remainder of 2025, there's actually 30% odds of a hike. What's going on there, we don't agree with there being a hike, but what's happening there is pricing in how inflationary policy in fact would be. So what policies will be will absolutely affect how the Fed acts, but I think that's very different than saying the government or the president is going to tell the Fed what to do.
Ken, how do you feel about this dynamic? You have the president weighing in more. Do you think that it does create concerns in the future about independence?
Well, I think the Fed's independent. I think Trump just likes to make some outlandish statements to rile people up out there. But I think the Fed's going to look at the data and do what they need to do to control inflation and keep employment up.
Cooler heads prevail. Ken Shinoda, Lindsay Rosner sticking with us for the next block. Still with us, Ken Shinoda of DoubleLine Capital and Lindsay Rosner of Goldman Sachs. Lindsay, I do believe spread makes a market, and of course that was a Goldman alumni speaking there. There's been a lot of debate here in the market about whether to buy at these levels when spreads have been so compressed. Would you back away from credit or dive deeper in given where yields are?
Sure. So we think it makes sense to have a moderate position in credit. So somewhere in the middle. We are certainly overweight, but we are not pedal to the metal. And the idea there is that spreads are tight. Any way you look at it, from a percentile perspective, we're in the 1 to 10th percentile of valuations if you look for the past 10 years. However, what's important here and what encourages us to still stay involved is that we think spreads are supported because the economy is in a really good place. I think world growth is going to be something around 2.7% for 2025, US 2.5%, buoyed by the consumer who's doing well and has had a great net wealth increase, even wages up. So this for us is a good growth backdrop to support spreads at a tight level. That being said, we don't disagree with Katie in terms of investment grade looking very full. But we really do like high yield, and I would say being invested and being at the table has been the right trade because high yield, if you just look at the index, is 30 basis points tighter in the first couple weeks of the year alone.
What would you like to buy, Ken? Because if spreads are this tight, but yields are still high, does it really raise the inclination to go down the spectrum in terms of credit quality? Do you take on credit risk at this point?
Yeah, well, the credit curve is really flat, meaning the difference in spreads for buying higher quality investment grade bonds relative to going down the capital structure or rating spectrum into more below investment grade bonds. So I think even, we like parts of the high yield market, but you don't want to chase the junkiest stuff. You don't want to chase the triple C's that have done it really well recently. You want to kind of move up in credit right now, increase the credit quality of your portfolios. And there are pockets of the market that still look cheap. If you go outside of the corporate credit markets into the securitized markets, things like asset-backed securities and CMBS still look not as wide as they were back in 2020, summer of 22, or even to start the year, but they're still 40th to 70th percentile, and we see a lot of value in those markets.
Do you agree, Lindsay? If you're looking for places to kind of find the extra value for 2025, do you start to get into the more securitized products?
Yes, that's been a big position for us in 2024, and we continue to hold it in 2025. On the margin, we've been rotating up in quality, to Ken's point. Out of the triple Bs in structured product, we're up in quality. We're finding triple As to be interesting. But I think it's really about doing that active management, that security selection, really digging into collateral, because that's important. For example, may seem surprising, office is a trade we really like, but we like specific office. We don't like all office. And so it really is a market of security selection. This is not a market where having beta on or just being exposed to spreads is going to win. It's about really doing your homework. So we like to build diversified portfolios, some double Bs, single Bs, and high yield, some CLOs, some CMBS. That we think is going to be the winning combination for this year.
What a beautiful mosaic of credit assets here. When you think about office in particular, Ken, let's double down there. Are you willing to really dive into the office sector after how bloody it was last year?
We are, but as Lindsay noted, it's very selective. The office market is a fascinating thing to talk about with investors. I just look at Los Angeles here. We have one of the best office markets, and we have one of the worst office markets in the U.S., and they're about 15 minutes away by car. Century City is doing very well. Vacancy rates are low, and the crime is low. There's not homeless people running around, and people want to be there. They've got Type A office with all the amenities, and its location is great, and so that market's doing really well. And you flip to downtown LA, and ever since COVID, has never recovered, and it's suffering, and vacancy rates are high, and companies maybe they don't want to be there anymore. So you have to just do your work, and it's very deal by deal. It's very not only geographically specific, but it's property specific.
Lindsay, how do you feel about the opportunities in office? How do you make sure that as you dip into the space that you're avoiding some of the future pains?
Sure. I think it's looking at the specific tenants, who the tenants are, how those leases roll off, the quality of the building, how much money is going to have to go into improvement, all the things that you think you need to look at and think about, the prospects of those cities for the future. But I think Ken makes a good point that even within a specific city, there are trophy properties and there are non-trophy properties. So one of the statistics that we thought was interesting is that delinquencies on office are around 10%. But that isn't at 10% across the board. So there are ones that are in really good shape and ones that are in really bad shape. And so it's doing that homework once again to figure out where you want to be.
Ken, I want to go back to something Lindsay was talking about a little earlier, this prospect that some investors have baked into this market, that you are seeing a potential. Maybe not everyone believes in it. I know, Lindsay, you said you didn't, but a potential rate hike down the road. How do these assumptions change if you do see that? Do you see some of these sectors that are coming back to life, like leverage loans or like office, just really get hammered in that scenario? How do you protect against that?
Well, definitely interest rate sensitive sectors will probably suffer from that. The commercial real estate market, especially, a couple of years ago when the darkness started for commercial real estate, the saying was survive till 25, because back then market participants felt if they could make it till 2025, we'd be finally cutting rates, and long-term rates would come down, and financing options would open back up. So a reacceleration of inflation that caused a rate hike, the whole curve would back up. The long end would go above 5%. That would put pressure on, I think, equities, and then put pressure on spreads. So it would cause both equities to fall and spreads to widen, I think.
Lindsay, favorite trade at this juncture?
Favorite trade. There's so many. You're not supposed to have a favorite child, but I will pick one. I would say AAA CLOs right now.
Ken, you?
Oh, I like what Lindsay was talking about earlier, that diversified basket of credit. Stay diversified, high yield, parts of the double B and single B still look good. Pockets of the securitized credit markets, you can still find, spreads for about 100 to 150 for high investment grade bonds. If you go down to kind of single A, triple B, you can get even 300 spread. So I think diversified credit looks great here as a complement to equities and an option instead of buying stocks.
Certainly sets up for a very interesting year in investing. We have to leave it there. Thank you both for your time. That is Ken Shinoda of DoubleLine and Lindsay Rosner of Goldman Sachs Asset Management.